All right, we are live. Hope everyone's doing really well. Looks like there's quite a few people in the audience today. Just drop a message into the chat if you can hear us okay. I just want to do a quick sound check. Chat should be on the screen somewhere. Oh, there's a few people coming in now. Donna, Kate, Martin, Suzanne, Derek. Appreciate you dropping a comment in. Ben, nice to see you all. Thanks for joining us today. We'll quickly just wait for a few more people to join before we kick off. If you drop a message into today about why you decided to sign up for this webinar, particularly if you've got a question that you really want to get answered, feel free to drop that into the chat. We'd love to hear your thoughts around where you are in your real estate journey, maybe what you're struggling with from a tax perspective the most. We've got Thomas here, who is a certified CPA, works for the Real Estate CPA, and he is very knowledgeable. So it's best to take advantage of this session. So if you do have any questions, either now or throughout the webinar, please drop them into the chat so we can answer them. We'll just give it a few more moments here. All right, let's kick off. Well, hello and welcome everyone. My name's Logan Ransley and I am the co-founder of Landlord Studio. So we're a property management and accounting software. And we're joined here today by Thomas Castelli. And Thomas is a seasoned real estate investor, licensed CPA, and a financial advisor as well. And he's also the host of the Tax Smart Real Estate Investors podcast, which you might have heard online. Big part of the Bigger Pockets community as well, and a very prominent business that works in the real estate tax sort of sector. Welcome, Thomas. Appreciate you joining us today.
Well, thanks for having me, Logan. It's always an honor to be here with you.
Cool. So let's jump into it. So let's sort of give you a little bit of an overview of what you're going to learn today. So with tax season sort of finally here, it's coming up very quickly. We wanted to take a closer look at some of the top real estate tax strategies and deductions for landlords. So our goal today is to help you understand these tax saving strategies so you can minimize your tax liability and maximize your deductions while sort of simplifying your property management. And towards the end, I'll demonstrate sort of how Landlord Studio can help you particularly in tax time when it comes to generating reports and understanding cash flow, figuring out exactly where money is being spent. And it'll also help you understand how you can move away from things like spreadsheets, outdated paper, and sort of those manual workflow processes. If you've got any questions, again, please drop them into the chat. We'll either try answer them throughout the webinar or we'll do a Q&A right at the end, depending on how many questions people are asking. So let's dive in and learn a little bit about maximizing tax deductions. So just before we start, I want to give a quick disclaimer. So the information and strategies in this webinar, they are complex, and whilst we want to take full advantage of the tax law, the information here is just provided as a sort of general education purpose. And it's advised that you do actually consult with qualified financial professionals such as Thomas and his team before making any sort of, absolute financial decisions. So just a quick disclaimer before we sort of jump into it. So the first part we're going to talk about is tax deductions in real estate. So the US tax code is very favorable to real estate investors. We generally know that, and that's why a lot of people do get into real estate. It allows you to deduct the majority of your rental business expenses and significantly or even entirely erase your entire tax liability if you've got the right structure in place. With that being said, in a recent study we conducted here at Landlord Studio, we found that 34% of surveyed landlords said they missed over $500 worth of deductions on every single property that they had. And a further 40% said they missed over $250 worth of deductions per property because they didn't record the right data in the right way. So as a landlord or investor, every dollar saved through these deductions means more cash that you can reinvest back into properties, growing that sort of future financial wealth. So we'll go into more detail on common tax deductions later, but it's fair to say that missed deductions can it will cost you a lot, thousands of dollars every year. But it doesn't have to if you have the right knowledge and the right sort of structure in place. So before we get into the sort of crux of the webinar, it's really essential to know the difference between sort of operating expenses, capital expenses, and the different sort of expenses that happen within a rental property business. So let's sort of dive into a few of the definitions, and then I'll get Thomas's view on deduction, deductible versus capital, etc., and how they're treated differently. So operating expenses can be deducted in within the full tax year there, where they occur. And these are regular and necessary expenses that come with operating a rental business. Things like maintenance, repairs, although some repairs can be considered capex, but general maintenance, insurance is a big one that people miss. Lots of these sorts of outgoings that happen every single month or annually within that tax year that are just considered sort of operating expenses for a business. Capital expenses, on the other hand, are those sort of big ticket items that typically add value to the property. Now, these expenses can't be deducted immediately. Instead, they need to be capitalized and sort of depreciated over time. So would love to get a really quick explanation from you, Thomas, about sort of the process of capital expenses, capitalizing them, and maybe just give a really brief example of what you've seen and what you typically used to seeing in the CPA world.
Yeah, absolutely. So there's actually a lot of really complex rules. There's like an entire section of the tax code called the tangible property regulations that regulate capital expenditures versus, like, say, repairs and maintenance. So what I'll do is give some basic guidelines, right? So, kind of like Logan mentioned before, a property that's going to last longer than a year typically is going to be capitalized. And when it's capitalized, it's usually going to be depreciated over several years, and you'll receive a depreciation expense each year for it. Whereas repairs and maintenance and general operating expenses are typically going to be immediately deductible. What that means is you're just be able to deduct those expenses in the current year. Now, to give some examples of this, I think it's the best way to illustrate this, right? Let's say that you have, you buy a property and you put a brand new deck on that property. That's typically going to be a capital expenditure. That's going to be capitalized and depreciated typically over 15 years. Now, if you have an existing deck on the property and you fix some rotting wood, that is most likely going to be considered repairs or maintenance, and that's going to be immediately deductible because you're not necessarily improving the property, you're just keeping it in current operating condition, right? Then another example of this is with the roof. If you buy a property and the roof is falling apart and you need to put a whole new roof on it, there's a good chance that that is going to be considered a capital expenditure. But if you just need to replace a few shingles, then that would be considered repair and maintenance, and that would be currently deductible. So generally, big renovation projects will be capitalized and depreciated, but minor repairs and maintenance, it will typically be currently deductible, and that's usually what you see here with the deductible versus capital expenditures. One more thing I'd add in there briefly is that items that you repairs and maintenance and capital expenditures, anything you really do to the property before you quote unquote place it in service, and that's when it's rent ready and listed for rent, will typically be capitalized and depreciated rather than expense. So just kind of a quick distinction, like anything you do before that point will be capitalized. Then after that, that's when you kind of get into that repair and maintenance versus capital improvement territory.
Awesome. So now that we've sort of got a grasp on capital versus operating expenses, we're just going to look into the sort of step-by-step guide to maximizing the tax deductions whilst sort of considering capital versus operating expenses as well. Let's just see, there's one question here, the HOA fees, special assessments for hurricane damage. I think we might answer this right at the end, Angela, because we're going to we're going to jump into a few more of these things as we go through the webinar. So just hold that thought right there. So the first on the list, and this is sort of what Thomas alluded to, is depreciation. So if you've attended any of the previous tax webinars that we've been hosting, you may be familiar with depreciation now. So today we want to just dig a little bit deeper into how depreciation works and some of the complexities around sort of leveraging depreciation to its fullest. So for those who aren't aware, depreciation allows you to deduct the value of the property, excluding the value of the land, over what the IRS deems its sort of useful life. So for residential properties, this is 27.5 years, 27 and a half years. Commercial properties, it's 39 years. Depreciation is the IRS's way of allowing investors to account for, wear and tear on a property. And then cost segregation, which is another sort of element to this, then allows you to sort of split out the value of non-fixed assets in your property and accelerate the depreciation of them using the individual asset's sort of useful life, which is defined by the IRS. So, Thomas, we'd love to get you to cover a little bit more about how that works and why an investor might find that quite useful. And why they might actually do a cost segregation study.
Yeah, yep, absolutely. So kind of how Logan mentioned, when you buy a property, if it's residential, it's going to be depreciated over 27 and a half years and 39 years for commercial. So let me just paint a picture of what that would look like, and then I'll kind of dive into why you consider a cost segregation study. So if you were to buy, say, a $500,000 property, and let's say $400,000 of that was the building, right? Because the land is never depreciated. So the building is $400,000. If it was a residential building, you're looking at getting a depreciation expense each year of roughly $14,545. And that's not bad. That's going to help you reduce, it's going to be on your on your profit and loss statement as an expense. It's non-cash. So it's going to help you reduce your taxable income, or at least the amount of tax that your taxable rental income. Okay. And that is powerful. But what happens is when you buy that property, when you buy that house, you're not just buying the structural components of the house. There's all these different types of other components in the house, such as, I can't believe I'm drawing a blank here, appliances, carpeting, fixtures. Then there's going to be land improvements like those decks, the pools, things of that nature. Those types of property are depreciated over a shorter class life. So for example, appliances are depreciated over 5 years. And then you have a pool, for example, would be depreciated over 15 years. So what a cost segregation study does is it breaks down the components of your specific property and gives you a report saying, here's all the various components of your property and their class lives. So if you have, say, 20% of the property that's allocated to tangible personal property, that 5-year property, you're now depreciating that over 5 years instead of 27 and a half years, which is going to accelerate and increase your depreciation expense. So now, why would someone want to do something like this? Why not just take it all off of 27 and a half years? Well, that's because there's a few reasons for this. The first reason is the time value of money. And time value of money states that if you can save that $1 today is worth more than $1 tomorrow. So if you can accelerate your depreciation expense and use it to decrease your taxes today, then theoretically you could take that tax savings and invest it. I'll just give you a quick example of the time value of money. If you had $10,000 in tax savings and you invested at an 8% compound return for 10 years, you're going to end up with $21,000. I think it's roughly $21,000. And that's basically $11,000 that you did not have before. So if you were to take this $10,000 and pay it to the government, boom, it's gone. You're never going to see it again. But if you're going to take that $10,000 and you reinvest it, you can actually make money off it. So that's the reason why someone would want to do this. Basically, you're accelerating your depreciation expense, increasing it, using it to reduce your tax liability today, and then presumably taking that tax savings and reinvesting it to grow your wealth. So that's why someone would consider a cost segregation study.
Yeah, I really like that analogy of dollar, saved is going to be a much more valuable in the future. So I guess that's why you would break it down and start to accelerate some of these different areas of the property. So let's sort of talk about bonus depreciation, because this is a talking topic that's been sort of in the industry at the moment. So bonus depreciation was sort of expanded in 2017 as part of the Tax Cuts and Jobs Act, allowing landlords to take 100% depreciation deduction of qualifying assets and improvements in the first year instead of having to depreciate it over time. It has begun to sort of, well, it was being phased out. However, there is currently a bill in the Senate that would extend the 100% bonus depreciation to 2025. So just to get your view on this, Thomas, what are the sort of qualifying assets in this case? And what do landlords need to know about that sort of 100% bonus depreciation scheme?
Yeah, absolutely. So bonus depreciation is actually one of the big reasons why you would do a cost segregation study, right? Because property with a class life of less than 20 years can be bonus depreciated. So here's kind of what bonus depreciation, let me give you an example. It's the best way to paint the picture here. So if we go back to our $500,000 residential property, we're going to remember that $400,000 of that is actually the building, which is depreciable. Now, when you do a cost segregation study, somewhere between 20 and 30% of that building value is going to be reallocated to this 5, 7, and 15-year property, which has, again, a shorter class life. But it also qualifies for bonus depreciation. So let's just say that this $400,000 property, you run a cost segregation study, and somewhere in the middle, 25% qualifies as this 5, 7, and 15-year property. So it's going to be $100,000. Now, with 100% bonus depreciation, you would be able to take this entire $100,000 deduction in the first year. Now, remember, this depreciation deduction is non-cash. So if you had a modest $500,000 rental property and you generated, say, $10,000 in rental income, I'm just throwing out a number here, it might be a little bit more, then you're going to have all your operating expenses. And now you're going to have this big, fat $100,000 non-cash expense, which is certainly going to leave you with a very sizable loss. And using certain strategies, this can actually be used to offset your active income, such as your income from a job or business. And I know we'll talk about that a little later, how you could do that. This can significantly reduce your tax bills. I mean, we've seen clients save 5 to 6 figures in taxes per year using cost segregation studies and bonus depreciation in combination with some other strategies. So that's why you'd want to use it. Now, some things regarding the amount of bonus depreciation you can claim. So bonus depreciation was 100% from September 27, 2017, very specific date, all the way through 12/31/2022, so the end of 2022. Then what happens is it phases out 20% every year until it's completely phased out in 2027. So in 2023, it was 80%. In 2024, this year, it's going to be 60%. In 2025, it's going to be 40%. 2026, it's going to be 20%. 2027, it's going to be gone under current law unless it's extended. Now, there is a bill that has been passed by the House. It's currently waiting on the Senate to vote that would extend 100% bonus depreciation retroactively to 2023 through 2024 and 2025, and then presumably 2026 it just drops to 20%. But that bill right now is there's no date as of right now for the Senate to vote. Many tax professionals believe that they're going to try to shoe it in with a spending bill in early March. So we'll have to wait and see. But right now, under current law, it is 60% for 2024, meaning if we go back to our example, the $400,000 property with $100,000 being eligible for bonus depreciation, you'd get a $60,000 deduction this year, not the full 100, because we're using 60% bonus depreciation.
So I guess in summary, this is really being discussed in the Senate or being voted at the moment. So watch the space, make sure you're keeping up to date with this, because it could, really provide you with a significant opportunity to offset some of these taxes. So just a sort of final note on depreciation or on the depreciation is the process in which IRS reclaims a portion of that depreciation that you can claim against your taxes. So depreciation recapture is sort of how they describe it. And it's important to note that the IRS will claim depreciation recapture whether or not you claim any depreciation on your property or not. So it's really important to consider this in your overall tax strategy. So I'd love to get a quick rundown, Thomas, on sort of how depreciation recapture works for somebody that's used the sort of straight line depreciation, or how they should be considering this in their overall tax strategy.
Yeah, absolutely. So when you take straight line depreciation, let's start from here, right? So when you buy your property, you're going to have your property, the cost of the property plus some of the closing costs. That's going to become your unadjusted basis. That's what it's considered. Now, every time you take depreciation, it's going to reduce your unadjusted basis. So every year using straight line depreciation. So straight line is just that straight line. We'll go back to our example for this. So if you have your $500,000 property, $400,000 depreciated over 27 and a half years, that's straight line depreciation. So that's going to give you an expense of $14,445 roughly. Every single year, you're going to take that expense. Now, if we go back to the $500,000 property, that's going to be our unadjusted basis, $500K. Okay. Now, after year one, we're going to go ahead. We're going to have an unadjusted basis of $485,454, and that's because you're subtracting your depreciation, that $14,445 depreciation expense against your cost basis to give you your unadjusted basis. So if you were to own the property for 10 years, we're going to go ahead and just kind of calculate this up. Your adjusted basis would be $369,090. So I'm going to go ahead and just copy this on my handy dandy calculator. So if you were to sell this property, right? Say you sold this property for $750,000. It appreciated. You made money, great, right? You're gonna be okay, great. I have a $250,000 capital gain, right? 750 minus 500, boom, I'm great. No, there's gonna be a greater gain. Your total gain on the property would be your 750 minus your adjusted basis, which is going to be $369,090 because you took depreciation over the course of your ownership. So your total gain is not 250; it's more like 380,000, right? So what happens is that amount of depreciation you took over the course of ownership, over the course of that 10 years, is really $130,900. So that is going to be that's going to be considered depreciation recapture. And you're going to pay tax on this $130,000. With straight line depreciation, it's at ordinary income rates up to 25%. So the maximum you'll pay on it is 25% if you're in a higher tax bracket. And the reason why it's 25%, people might be wondering, well, don't we have a 24% tax bracket, then a 32% tax bracket? Well, 25% was the old 24% tax bracket before the Tax Cuts and Jobs Act, and they never rewrote the laws to fix this, so it's just capped at 25%. So that's kind of how it works. Depreciation and recapture works in a nutshell.
Super interesting, eh? Let's jump into the second sort of short-term tax strategy. So a pass-through deduction allows you to sort of deduct up to 20% of your qualified business income, QBI, on your personal taxes. So when you own a rental property as a sole proprietor via a partnership or through an LLC or S Corp, known as sort of pass-through entities, the money you collect in rent is considered QBI, so qualified business income by real estate tax law. The provisions of 2017 Tax Cut and Jobs Act are currently set to expire sort of in 25, as Thomas alluded to before. So love to hear a little bit about the passive income pass-through deduction, Thomas, and how landlords and real estate investors can sort of apply this to their own portfolios of property.
So I'll break this down a little bit. So in order to qualify for the QBI deduction for your rental properties, there's actually a safe harbor that they created because there's an argument in Congress when this was first passed, like, do rental properties even qualify for QBI? So they did a safe harbor, and that safe harbor said that if you have anybody, not just you, but anybody work on your property for 250 plus hours for the year, then you can qualify, and you can group your properties together as long as they're in the same. As long as you can group residential properties together and you can group commercial properties together, but you can't mix and match. So that's the kind of the first hurdle to get over this is you want to be able to make sure you meet that safe harbor. But surprisingly, we don't really see too many investors, real estate investors specifically, use this. And that's because most real estate investors have a lot of losses on their rental properties thanks to depreciation, which we just discussed. So oftentimes I'd say, I don't want to throw a percentage on it, but I'd say probably 90% of the time, if I had to throw a number out there, you don't really see people use this because they don't have any QBI. They have loss. So it doesn't really help them in that sense. However, if you were to say have rental income and you met the qualifications for it and you were under the income thresholds for this, because there's income thresholds, you could phase out the QBI deduction if you're over a certain amount of income. In 2024, that's going to be $383,900 for joint filers and $191,950 for single filers. If you're above those, you don't get the full 20%. You're going to get a partial deduction up until $483,900 for joint filers and $241,950 for single filers. So just be aware of those income thresholds. But assuming you were below those and you had $10,000 of rental income and you qualified for this, you're going to get a $2,000 deduction for QBI. So that's QBI. It's a little bit more complicated than that because it can interfere with other types of business income you might have. But so make sure you talk to your tax professional if you are thinking about using QBI. But that's typically that's what it is in a nutshell. And just want to caveat that with, we don't see that too often because of the losses that depreciation produces.
Cool. So let's jump into another quite an interesting tax deduction or tax strategy. So home office tax deductions. So the home office deduction is one of the more complex ones. And it's essentially the cost of any workspace that you use regularly and exclusively for your real estate business. And it can be deducted as a home office expense. So there's a few important caveats here, such as, the space needs to be separate from other parts of the house and used exclusively for your real estate business purposes. For example, you can't just go and convert the corner of your lounge or living room into an office and say, this is for my rental property business. So while this deduction basically works on the honor system, you should be prepared to defend your deduction in the event of an IRS audit. So, Tom, what do listeners need to know if they want to claim any sort of home office deduction, and what are the benefits of it?
Yeah, absolutely. So I'll start off with the requirements. I'll get into the benefits and then some caveats here with rental properties. So to qualify for the home office, the office in your home needs to be exclusively for business purposes, as Logan mentioned, and it needs to be the sole place where you operate your business, or the primary location for your business. So for a lot of real estate investors, that's often the case because you don't have an office for your real estate. You work at your home office. So that's how you qualify. Now, the benefits are if you do qualify, there are two different ways you can take the home office deduction. The first one is called the simplified method, and that's simply $5 per square foot of your home office. Very simple, up to 1,500 square feet. So you get a total deduction. I think that's $300 max. So that's the simplified version. The other version is the actual expense method, where you take a portion of your expenses of your overall home based on the business use of your home office compared to your entire home. So for example, if your home office was, keep it simple, 500 square feet, and your total home was 2,500 square feet, that would be, I think, if I'm doing my math right here, that's going to be, I'm doing my math wrong here. I think that's about 25%. So you would take 25% of your entire home deductions, entire expense related to your home, your mortgage interest, your utilities, your internet, your phone bills, all of that would be partially deductible. And specifically within that, whatever is for your home office, 100%. So say, for example, this desk that I'm have my computer on, this chair that I'm sitting on, that would actually be 100% deductible because it's 100% related to your home office. So that's kind of what the benefits are, is you get a deduction for this. Now, the caveat here is that you can only take the home office deduction to the extent that you have income from the business that's associated with. So if you have a loss, which is generally the case with rental real estate, you're not going to be able to claim the home office deduction itself. However, you would still want to take or put the home office on your tax return, because I think we're about to get into this in just a second too. Um, when you have your home is not a place, your home is not considered a place of business unless you have a home office. And when you travel from your home office, say to Home Depot, well, now that's a business commute. Whereas if you don't have a home office, it's a personal commute. So having a home office can help you maximize your vehicle related deductions, despite the fact that you might not be able to take the home office deduction. Now, what would actually happen to that deduction if you can't take it? It just gets carried forward to the next year. But it's just something to know. If you look at your tax return, you say, why don't I have a deduction for my home office, but you have losses from your rental real estate? Then that's why.
And that sort of brings us into a really interesting deduction here. Let's just take a question from Derek. I've just seen one come through. I have a space on the third floor of my 4-unit. Could I finish that into an office and use that as a office deduction? I do not live in my apartment building.
So can you use, okay, so you have a third floor on an apartment building that you're renting out. So it's not your home. That typically would not be considered a home office. You might be able to, yeah, I don't want to get too far down the rabbit hole here, get too complex, but you might be able to rent it to yourself. However, renting it to yourself can come with certain complications. So the long story short of it, because it's not your residence, it's not going to be a home office, but you could still potentially use it as an office. And there's some asterisks there on the deductibility of such, but yeah, it wouldn't be home office to answer the question.
So let's jump into the travel and mileage, because I think this is really interesting to the last point. So one of the main deductions investors often overlook is the travel and mileage expense. So in fact, we did a survey last year, and only 17% of all the landlords that we surveyed actually track their mileage, which is crazy.
Yeah.
Yet 74% said they traveled over 100 miles for their business in a single year for a single property. And 42% said they just traveled more than 500 miles overall for the tax year. And this can account for hundreds of dollars worth of missed expenses, and doesn't even account for other business travel expenses many investors will incur. And this sort of goes to Thomas's last point, in the case of using a home office as well, because going to and from the home office is also considered a business travel expense in the case of being used for the business. And so part of the reason why mileage is such an overlooked expense is that, claiming it requires keeping a very detailed log that includes miles traveled, purpose of the travel, time and date. And when sort of claiming these travel expenses, you again need to have a log of everything. And this really just goes to the point that unless you record your trips in real time and actually keep a log of everything, then you're likely going to miss all those expenses. You'll forget about them. You'll forget the purpose. They just happen as they do. And really, this is a very missed expense. Well, this is why it's such a missed expense, a greatly missed expense in the case of rental properties, because most people just don't keep these logs, which is why we've actually built a GPS mileage tracker into Landlord Studio. But we'll get into that a little bit later. But Thomas, I'd love to sort of hear the continuation of thoughts from the last slide in terms of home office and travel and mileage. And again, what are some of the sort of big deductions that you see investors forgetting? Yeah, I would love to hear your thoughts on that.
Yeah. So there's actually, so the first thing is, like kind of Logan mentioned, some people just fail to track their mileage, right? So there's two ways to deduct your vehicle. One of them is going to be the standard mileage deduction, which is very simple. You're going to take the amount of miles you drove for business. You're going to multiply that by the rate. I think it's like 62% for this year, if I'm not mistaken. So it can add up to be quite hefty if you drive a lot for business purposes. So you're going to make sure that you track your miles. Again, you can use something like Landlord Studio to track it. Just make sure you're tracking it, because you don't want to miss out on those deductions. You don't want to claim deductions and then get audited and not be able to substantiate. So go ahead and track those miles. But now there's a second way you could actually deduct your vehicle, And that's called the actual expense method. And the actual expense method, just like kind of how it works for the home office, you can deduct a portion of your actual expenses related to your vehicle as long as you use your vehicle more than 50% for business. So let's just say you had $10,000 in vehicle expenses for the year, eligible vehicle expenses, and you use your vehicle 75% for business. Well, you'd be able to deduct 75% of those expenses. So depending on which one kind of depends, right? Which one makes more sense depends, because sometimes the standard mileage deduction can actually amount to more than your actual expenses if you have a lot of miles. So you're going to want to speak to your CPA, your accountant about that before you make a decision on which one to ultimately go with. But I will add in this, that the actual expense method allows you to depreciate your vehicle. So depending on the type of vehicle you have, if you have a vehicle like a truck or an SUV that weighs over 6,000 pounds, use it more than 50% for business, you can actually bonus depreciate your vehicle. And this can be quite powerful depending on the cost of the vehicle you have, the amount you use it for business, so on and so forth. So that is probably one of the big things that people often miss, is that you can actually bonus depreciate certain vehicles. So again, you're going to want to sit down with your CPA and just ask them, hey, I have this vehicle, or I'm thinking of purchasing this vehicle. What is the best way for me to deduct this for my business? Because you can easily miss out on large deductions if you choose the wrong method. Logan, I think you might be on mute.
Oh, sorry. Yeah, really interesting. And I think, we just see this all the time with our own users, not and new users coming on board. That historically they've just never even thought about it. They've never deducted any of these things, but every single one of these expenses that you miss will ultimately add up to less tax savings overall. So it's really important just to get a system in place that can help you do all of these things and make sure that you are tracking all of these things in real time. Let's jump into number 5, which is a 1031 exchange. So these are more sort of long-term tax planning strategies. So if you want to get really serious about sort of maximizing returns, then you need to be thinking sort of long-term. And the real estate game is a long-term investment strategy overall. So that's what we always recommend to our customers and our users. So this next section is really dedicated specifically to a few of these sort of longer-term tax strategies. So the first one is the 1031 exchange. And this really just helps us explain capital gains overall and how it can be applied. So you may have a capital gain on your property when you come to sell it. Sure, it looks really good on paper, but I guess the question is, have you thought about all the taxes you'll owe if you try to actually realize those capital gains in terms of selling and then receiving cash? And this is ultimately where the 1031 exchange comes in. So the 1031 exchange provision allows investors to essentially defer the capital gains taxes when selling an investment property by immediately reinvesting the proceeds or the money received into another, what we call like kind property, something that is like the last property that you've just sold. Now, you can use sort of 1031 exchanges indefinitely, but when you finally want to cash out, you will have to pay any taxes owed. So love to get your insight on this, Thomas, and what are some of the sort of caveats of a 1031 exchange?
Absolutely. So 1031 exchanges are honestly a very powerful tax strategy. We've seen clients use these for decades and just continue to sell their properties, defer the taxes they have to pay, and buy larger and larger and larger and larger properties, and have these massive empires built off of 1031 exchanges. Like, it's real. People really do this. So the way the 1031 exchange works is when you sell a property, you have 100. If you execute a 1031 exchange, you're going to have to use a qualified intermediary, aka QI. They're going to have to receive the cash at the closing table. So you're going to have to be engaged with this QI. You're going to have to make sure they're on the same page. And when you close on the property, they're going to take the cash. If you take the cash, 1031 exchange is dead. It's over before it even begins. So From there, if you're going to do this, you have 180 days from the date of sale to close on your next property. And within that 180 days, the first 45 days, you have to typically identify up to 3 properties that you're going to 1031 exchange into. So 3 potential replacement properties. So that's how the 1031 exchange works. Kind of from a timeline perspective, it's really important to keep those timelines in mind because the IRS is extremely strict on these timelines. Okay, and then once you 1031 exchange, the benefit of the 1031 exchange is you get to defer your capital gains and depreciation recapture on the sale of your property and use those proceeds. Remember, I could take the tax savings, in other words, and use it to buy a larger or better property. Now, the caveat of the 1031 exchange is that when you buy that next property, your unadjusted basis, remember we talked about your unadjusted basis before and how it basically determines, if you use a cost segregation study, how much depreciation you're going to have, especially with bonus depreciation. Well, your unadjusted basis in this replacement property or the new property you purchase isn't going to be the price you bought the new property for in most cases. It's actually going to be closer to the unadjusted basis of the property you sold. So when you 1031 exchange a property, if you go and run a cost seg study on this new property, the depreciation you're going to get from it may not be as large had you just bought the property outright, right? It just in a normal sale. So that's just something to keep in mind. That's known as, it's not an official term, but people call that basis erosion. Because as you do more and more 1031 exchanges, you're going to have an unadjusted basis that's a lot lower. Sometimes if you do this over decades, extremely low. Like you might have an adjusted basis of 170K, for example, 170,000, but a building value that's worth $10 million. Like that could happen. And if you sell, you're going to have a massive capital gain. I'll throw one more thing in here. Some people, depending on your state and how much your state is worth and things like that, some people will 1031 exchange until they pass away. It's called 1031 until you die. And when you pass away, your heirs receive the property you have at a stepped up basis, which is the value of the property at the date of your death. So in other words, if you were in this situation where you have a $10 million property with a $170,000 basis, if you were to sell that, you have a massive capital gain. The day you pass away, your heirs can receive that property at $10 million. If they sell it the next day for $10 million, they don't pay any capital gains taxes or depreciation recapture. So that is kind of how a 1031 exchange works in a nutshell and kind of where you could take it.
That's quite interesting on that last point of the inheritance and how that, I guess, just how the tax laws work around that. So I think these are all really important to sort of consider, and that's why we always recommend going with a certified CPA that specializes in real estate specifically, because they know the insides and outs of all these different sort of tax laws. So let's jump into number 6, which is an opportunity zone funds. So opportunity zones are sort of low income or disadvantaged tracts of land as designated by the Department of Treasury. So this is part of the 2017 Tax Cuts and Jobs Act that we sort of referred to before. And the goal of the opportunity zones is to encourage investors to put their money into developing and economically stimulate those communities by offering sort of tax breaks. Essentially, your unrealized capital gains go into qualified opportunity fund, and the money from those funds goes towards improving sort of selected areas. So if you play the rules of the program, you can enjoy the following sort of tax advantages. So deferring paying capital gains until 2027 or until you sell your stake. Grow your capital gains by over 10% if you hold the fund for 5 years, 15% for 7 years. You can avoid paying capital gains tax entirely if you remain invested in the fund for 10 plus years. So the tax breaks that you sort of get from this are quite interesting. And this expires on the 31st of December, 2026. So love to get your insight into these opportunity zone funds, Thomas, and if you've had any experience with clients doing this before, or what investors should be looking for when they are looking into this specifically.
Yeah, opportunity zone funds, super interesting topic. So first, a few things I was clear up here. I think the main benefit of it today in 2024 is that 10-year benefit. So say, for example, if you invest in an opportunity zone fund, the gain on the opportunity zone fund itself. So say, for example, you put $100,000 in today, and in 10 years from now, it was worth $1 million, right? Your interest in the qualified opportunity zone fund is now 10x. Well, you're not going to pay tax on that entire gain, the entire $900,000 gain. You won't pay tax on it. That's the biggest benefit today, and that's because if you invest your capital gains in a qualified opportunity zone fund in 2024, you're not going to be able to get the 10% step up anymore or 15% step up because you had to invest by the end of 2019 for that 7 year, or by the end of 2021 for that 5 year. Now, all you can do is defer until 2026 when you have to pay the taxes. So the real benefit of it, again, is taking your capital gains, deferring them until 2026, but really being able to wipe out the taxes on the qualified opportunity zone fund itself. And this is not trying to plug this in here, but we have episode 204 of our Tax Smart REI podcast, where we have a gentleman named Barrett, who is in this space, operates in this space heavily, break down the true benefits of the fund in a way that I've never heard before and that I cannot replicate. So go check that out if you want to hear the true benefits. But basically, you could keep the qualified opportunity fund open until 2048 and continually just grow this massive portfolio, and all the gains wiped out, right? If you invested in the fund and held it for longer than 10 years. Now, a few last things that I would say here that I've seen people get tripped up. If you're going to do this yourself, okay, if you're going to do this yourself, you're going to go invest in a qualified opportunity zone fund, it's important that you actually open a qualified opportunity zone fund. Simply purchasing a property in a qualified opportunity zone will not help you. It needs to be a qualified opportunity zone fund, which has to be structured as either a partnership or a corporation. So an S corporation, if you're going to be doing this yourself. So just something to keep in mind there. But again, to summarize this, the benefit is you invest in the qualified opportunity zone fund today, you defer your tax until 2026, and then the gain on the qualified opportunity zone fund itself, if you hold for 10 years, is going to be tax exempt. And that is the true power of a qualified opportunity zone fund.
Just drop the link to that podcast episode in the chat, but we'll also include that in the follow-up email with the replay for this also. So let's jump into number 7. We've got a couple more before we sort of start to wrap this up, so make sure you stick around. But number 7 is the sort of short-term rental tax loophole. So there's been a lot of talk about short-term rentals over the last few years. And essentially, investors with short-term rentals, they don't necessarily need to meet the qualifications of a real estate professional to reclassify passive real estate losses or as active losses. They only need to sort of materially participate. This classification also extends to properties with average stays of 30 days or less, and provide substantial services offered to guests during their stay. So just to get a little bit more light on this, Thomas, maybe give us a little bit more detail about this short-term rental tax loophole, and what are the sort of benefits of this strategy, and how can the attendees today sort of apply this to their portfolios?
Yeah, absolutely. Absolutely. So let me start here. So all rental activities are passive by default underneath the tax code. So what does that mean? That means if you have losses from your rental activities, which can be sizable thanks to bonus depreciation and cost segregation, everything we talked about before, those are typically not going to be able to offset your W-2, your active business income. That's just because it's passive by default. And all rental activities are passive by default. However, there is an exception. There's a set of exceptions, a handful of them, under the tax code regulations that basically will say that your rental activity is not a rental activity under the definition of rental activity. So those exceptions are if the property has an average period of customer use of 7 days or less. The other one is if it's 30 days or less and substantial services are provided. Now, there's a few other ones, but those more or less relate to hospitals, not necessarily owners of short-term rental properties. So if you meet one of those exceptions, 7 days or less, average period of 7 days or less, or 30 days or less, and you provide substantial services, which are hotel-like services that you might find in a hotel. If you meet one of those exceptions, great. It's not a rental activity, which means it's not passive by default. Now, if you meet a material participation test, your losses for that or income from that will be non-passive and can offset your W-2 income, okay, or your business income. And to materially participate, there's one of 7 tests that you have to meet. You only have to meet one, but there's 3 of them that are most relevant to most investors. And that's going to be you spend more than 500 hours on the activity, right? So you spend more than 500 hours, great, qualify. The other one is you do substantially everything. So you're like a one-person band. You have very little to no outside help. That's the second test. The third test is going to be you spend more than 100 hours and no one else spends more time than you. And that's the most popular test by far because 500 hours on a short-term rental property on one short-term rental, at least in my experience of watching a lot of different clients try to do this, is hard to get. So you're probably not going to meet the 500-hour test. Then doing substantially everything yourself, if the property is remote, probably not going to do that either. You need someone to do some stuff. So that's where the 100-hour test comes in. You spend more than 100 hours. You have some cleaners and handymen and whatnot work on the property. As long as they're not spending more time than you, you're in the clear. So that's how you qualify for this. You have to meet one of those exceptions, 7 days or less, or 30 days or less with substantial services, and meet one of these 3 material participation tests. And the losses from your short-term rentals specifically will be non-passive, not from your long-term rentals, but from your short-term rentals. So this can be a really effective strategy if you either want to invest in short-term rentals or you're willing to invest in short-term rentals and play the short-term rental game and are looking for a tax deduction.
And we have a few blogs that sort of explain this in a bit more depth on our website. So make sure you check those out as well. We'll include that in all the resources that we provide in the follow-up. So the final long-term tax planning strategy is, again, real estate professional status. So this is similar to what Thomas alluded to just before in the previous slide. And the real estate professional status is really a tax designation that individuals can elect on their tax filings that allow income and losses from rental real estate activities to be characterized as non-passive. So love to get an explanation on the real estate professional status, Thomas, and sort of how many hours you need to participate and how is it used in the case of a W-2 job. I know in the previous webinar, you mentioned about trying to do this with a W-2 job. It's very hard to justify to the IRS. So I'd love to get that example as well.
Yeah, absolutely. So basically, kind of going back to what I was saying a little bit before with the short-term rental loophole, all rental activities are passive by default. And that was put into place under the Tax Reform Act of 1986 to prevent high-income earners from using their rental properties, going out and doing a cost segregation study and taking these massive losses against their active income. But the real estate industry, they came in and they argued, well, hey, why can't we, I'm a developer, I'm a real estate agent. Why can they go and take their x-ray machine and deduct it, right? Depreciate it and take it against their active income. But why can't I take my rental property that I developed against my rental income? So they put into place the real estate professional status. And the real estate professional status says that to qualify, you have to spend more than 750 hours and more than half of your total working time in a real property trade or business. So effectively, this is for full-time real estate professionals. That's really what this is intended for. And the challenge is to qualify when you have a W-2 job or perhaps a full-time business that you're running is that the IRS considers a full-time job to be 2,080 hours per year or about 40 hours per week. Now, in order to spend more than half your total working time in real estate when you have a W-2 job, you would need to spend 2,080 hours, 2,080 hours, 2,081 hours in the real property trader business, which means that you're working now 81 hours per week for the entire year, which is virtually impossible. In fact, so impossible that there's hundreds of tax court cases of taxpayers trying to claim that they did this. And the tax court ultimately, the IRS saying, no, you didn't. And the tax court saying, we agree with the IRS. So it is extremely challenging to claim this status if you have a full-time job. However, I will say there are some strategies around this. The first one is that if your spouse can qualify and you file a joint return, then you both qualify. So that's one strategy. You might have a high income earning spouse. You might have another spouse working part-time or perhaps not at all. They could take over the real estate side of the business. They could spend more than 750 hours and more than half their total working time, and you're in there. The other way around this is the short-term rental loophole, which is like you don't need to work full-time in real estate to use the short-term rental loophole. You just need to meet one of those material participation tests. So a lot of people, if they can't use the real estate professional test, they'll go out and buy a short-term rental loophole. A short-term rental, use the short-term rental loophole to get around this rule, which is why the short-term rental loophole is called a loophole.
Interesting about the spouse situation. So it's quite important to consider as well if you've got two people sort of involved in this. And this is why you would sort of talk to your CPA about making sure that you are qualifying for these things. Let's jump into the role of regular reporting. And this is all the sort of comes to case when we start to look at the tax deductions, etc. So this is the last part of our webinar. And this is all about sort of using systems to be able to report on all these different deductions and categorized expenses, etc. So whichever sort of strategy you're going to use or need to record accurate financials, ultimately you need to show every single expense and every single income transaction. And you need to be able to produce detailed reports, especially if your portfolio is growing over time. Every single property is going to be treated differently. And so being able to analyze and pull data out of a specific property is going to help you with this process and help you maximize tax deductions on your entire portfolio. And that's why a really good, proper accounting system is quite important. So using your software, whether it's Landlord Studio or a general accounting platform like QuickBooks, it allows you to run those monthly reports on a quarterly, monthly, annual basis, etc. And it helps to keep everything organized as well. If you compare this to things like spreadsheets or paper documents or just simply exporting bank statements, it doesn't really give you the nuanced insights into saying these particular expenses are for these particular types of categories, areas of my business, so that I know exactly what it can be deducted at what rate, what can be depreciated, etc. You just can't get that from manual types of processes like spreadsheets, etc. as well. So what I'm going to do is jump into Landlord Studio and show you how our platform allows you to run reports and really see the sort of nuanced insights when it comes to tax preparation and maximizing tax deductions. So I've just jumped into here now, and basically what this is allowing me to do is run reports really easily. So once data is entered, I can simply log in on desktop or mobile. I get an overview of the sort of finances on our dashboard. I can click into the dashboard and sort of run these reports directly off all the finances that I see here. So in this case, I've got an income and expense statement, and we pre-populate all the categories from a Schedule E, which is a very typical tax form that you're going to fill out during tax time. All the categories that you see on the screen here under expenses are then associated to every single expense in Landlord Studio. So as you enter this data in, it's all nice and organized so that you can actually draw this information out very easily, in comparison to something like a spreadsheet where it's very hard to draw the information out for particular time periods as well. So in this case, we've got a trailing 12-month report. It's broken down by expense categories, and then I can actually go in and start to see all the information associated here. So from here, I can, run reports on particular properties for particular time periods. I can either drill down into areas such as capital expenses, for instance. So if I do have a capital expense that I want to run a report on pulling out all the capital expenses for, my CPA to do things like depreciation, etc., it's really easy to do that. And so what this allows me to do is really just draw down into all the different areas of my reporting, very simply using Landlord Studio. One of the benefits here is the Schedule E. So this really allows you to streamline tax time when it comes to just filling out a Schedule E, which is very common. We break down the format in the way that you need to fill out the Schedule E by category, which is pre-populated. We also explain, or we show days rented, occupancy rate, and what type of property it is as well. And these are all generated off the lease. So you can actually set up leases in Landlord Studio, log payments, track balances against leases, etc. And really what this is doing is organizing everything around a property specific view. And this is quite important because every single property is actually considered, or it needs its own P&L in terms of filling out a tax return. You can't just group all your income and expenses for all properties and then just put it on a tax return. They actually have to be broken down. And so what we're doing here is structuring the accounting software in a way that is broken down by property, which is quite different to how a typical accounting software will work, where it's typically designed for an individual entity. And so here, again, I'm running that Schedule E report. It's giving me all the information that I need. And then I can easily send it off, download a PDF, download the CSV file, view it in PDF format, and then share this with my CPA for tax time. And this helps your CPA really get the most out of all your tracking of income and expenses throughout the year. So regular reporting isn't just about sort of compiling this data. It's about sort of leveraging this data to drive your financial strategies in the future and optimize those sort of tax deductions and really just overall reduce your tax bill. And Landlord Studio is more than just that sort of accounting and tax preparation tool. It's sort of an all-in-one solution as well. So it can simplify sort of every part of your rental property business. So if we sort of look into a few of the features that also do relate into the accounting side as well. One is collecting rent online. This means that all funds become digital. So you can control the way that your tenants pay you through online rent collection to make sure that you're always receiving the right amount of rent, applying late fees. It's all driven off a lease, which has a start and end date and a payment date, etc. And this all flows into the accounting stack where when payments are made from tenants, then they're automatically added as a transaction in the property. You don't have to go in there and manually add that in the case of cash payments, check payments, etc. The next is maintenance requests, and this really sort of ties into maintenance expenses as well, and keeping tabs on, where are maintenance expenses being spent and how are these applying to each individual property. So tenants can submit maintenance requests in the portal. You can then effortlessly track them, monitor them, schedule repairs, etc. Finding and screening tenants. We all know that one of the most important parts of a rental property business is the tenant side, getting the right tenants, suitable tenants, etc. Because ultimately, at the end of the day, if you don't get paid income from your tenants, then your rental property business does not exist. And so we help our landlords find the best and most suitable tenants. We syndicate listings out to Zillow, Zumpa, Realtor.com, all the different major websites where you can actually find those tenants. We then help you run tenant screening, collecting leads, and then sending them through an application process into sort of e-sign, etc. So it's a whole workflow around finding tenants. And then tenant communications as well. So once those tenants are in the product in your property, then you can easily communicate with them through Landlord Studio's features. And then one of the sort of more important ones, particularly around the mileage function that we were talking about before. Mileage is often missed. We have a GPS mileage function in the Landlord Studio app. All you need to do is open it, push play, and then it starts recording your journey, and you can add notes to it. And that keeps a detailed log that you can then keep on file. The next part is receipts as well. So storing receipts and invoices for specific expenses allows you to then stay on top and actually stay IRS compliant in the case of an audit. So all these features are designed to around IRS compliancy and allowing you to maximize tax deductions overall. And the advantages of using an all-in-one system is that instead of using all the different tools that you might be used to, spreadsheets, Google Drive, all these different items, they all come into one platform and have a single workflow that is built around that as well. And so that just saves time, reduces costs overall. So you can actually focus on what really matters. So I'd love to open up the floor to the question and answers section. There's been a few questions in the chat so far. I'll just go back to them and cover them off. So Angela asked HOA fees and special assessments for hurricane damage deductible. Maybe that's a question for you, Thomas. I think you're on mute.
All right. I think you're talking about the California, the deductions in California. I'm actually not too familiar with those, unfortunately, personally. So I'm not going to be able to answer that question today.
No problem. My suggestion, Angela, would be to reach out to your CPA, and they may be able to help you figure that out and see if that's applicable to your rental property business specifically. Jerome, for furnished rentals, are furniture considered capital expenses?
Yeah. So furniture is typically considered 5-year property. So if you're like a short-term rental and you're buying furniture, you're going to furnish the property. It's typically considered 5-year property. However, so that is eligible for bonus depreciation. However, there's something called the de minimis safe harbor, which we talked about last time. We didn't touch on today, but it allows you to deduct expenses under $2,500 and regardless of whether they're capital improvements or not. And that was made to stop your depreciation schedule from just getting frivolous with all these little items, right? So to answer your question, furniture is typically considered a capital improvement, depreciated over 5 years. But if your property is already in service, you could use the de minimis safe harbor. If the piece of furniture is $2,500 or less, you could just immediately deduct it. Oh, Logan, I think you're on mute.
Angela, sorry, was talking about Florida. My recommendation would still be to reach out to your CPA, particularly if you've got a CPA in Florida specifically. They'll be able to help you with that. Kate, how do you do a cost segregation analysis? I know you asked this question a little bit back further as well, Kate, around assessing what portion of the property this applies to. But in this case, Thomas, how would you do a cost segregation analysis?
Can you say that last part again? And what was the reason why she couldn't do it?
So the first question, or the latest question, how do you do a cost segregation analysis? And she also asked earlier on in the webinar, how do you assess what portion of the property this applies to? And that's when we were talking about cost segregation as well.
Gotcha. So a cost segregation study is typically done by a professional. So there's cost segregation firms out there. They're typically engineering firms with tax expertise. And what they do is they'll come down to your property, almost like an inspection or an appraisal, and they're going to survey your property. And then they're going to give you a report of all the components in that property and what they're worth. And they do that they have usually databases of data and valuation techniques that are specific to engineers with tax backgrounds that are able to determine that for you. Having said that, there over the last few years with the advances in technology, there has been something called a software cost segregation study, or a desktop study as sometimes they're referred to, where you put a bunch of information about your property into a software, and the software generates reports for you using algorithms, national databases of costs and things of that nature. So that's typically how you do it. To summarize that, you either have a professional come down to your property and do the study, or you'll put it into software, and the software will spit out the study for you.
Cool. And the last question, to qualify for QBI, you said the 250-hour requirement can be from anyone working on your properties, not just yourself.
Right.
also all property hours can add up to the 250. Is that correct?
Right. So the way it works is that they call it a real estate enterprise, right? So you can group multiple residential properties together or multiple commercial properties for the purposes of getting this 250. And anybody can spend the hours. Somebody has to spend it. It could be your property manager. It could be a contractor you have. It could be you. It could be an employee that you have. Someone needs to, or in combination, right? Some people in aggregate on that bucket of properties, 250 hours needs to be spent.
Awesome. Well, I think that's all the questions. So just want to thank everyone for joining us today. And I hope you found this really useful and informative. Let's just quickly recap some of the key takeaways from today. So understanding and leveraging tax strategies can help you reduce your tax liabilities, increase cash flow. However, not every tactic will work with your goals and investment strategy. And incorrectly using these strategies can actually open you up to an IRS audit. So to leverage these tax strategies and these different tax deductions, you need to it needs to be in line with your overall goals of what you're trying to achieve with your portfolio. You also need to keep detailed and accurate records throughout the year and regularly run financial reports. And we recommend employing software like Landlord Studio to make that as easy as possible. And then finally, we strongly recommend that you need expertise in the space. Talk with your CPA, talk with a financial advisor before you make any decisions. Even reach out to Thomas and his team if you don't have a real estate CPA or you're unsure if your CPA is actually doing the job that they're supposed to be doing. So if you have any tax related questions, feel free to reach out to Thomas and his team. Whereabouts could they find more information about you, Thomas?
Yeah, the best place to do that is going to be by going to therealestatecpa.com/Thomas. There you can request a consultation if you're looking for a new CPA, or if you do have questions, our team will be able to point you in the right direction, the best way to go get answers to those. Or if you want to connect with me on social media, I have all my links at thomascastelli.com/links, and you could also ask there as well.
Perfect. And feel free to check out our selection of free resources on our website. We will send a replay link of this webinar in the follow-up email, along with that podcast episode that Thomas mentioned around the qualified opportunity zones. So make sure that you do check that email. It will come out later today or tomorrow morning. But we, really thank you for joining us today. And of course, if you haven't tried out Landlord Studio to see how it can increase your profits and maximize your tax deductions, we'll give you 14 days free. And for attending this webinar, we will also extend your trial as well, so that you can really find the benefit of Landlord Studio before making any decisions. So again, thank you for joining us today. And until next time, have a great day, everyone. Cheers.
Thanks again for having me.